What are your thoughts on how the declining M2 money supply will affect the S&P 500? Beautiful question. I've been thinking about this a lot myself, and you made me do all the numbers, which actually doesn't take a lot, but let's go back in history. So this is an old paper, an old study from 2007, and the result of it was the R squared was 87.3, which means the money supply explains 87.3% of the S&P price action. Hard to believe. Again, that's 2007 going back to 1950. Let's look at a little bit more information. Let's look at modern data. And I just looked at the last 15 years because I have all the data going back to 1950, but I thought this is more relevant because of what has happened with the increase in M2 money supply. So first chart I put together is comparing the M2 base money, which is on the left axis, and the S&P 500 on the right axis. S&P 500 is red, M2 money base is blue, and you can see how the money jumped up in early 2020, and we all know why. But even putting that aside, look how it's grown since 2008. It's just always climbing up the whole time. Now, the other thing I would like to cast your eye on is look at the way the blue line has dipped ever so slightly. And that's what we're going to examine a little bit. But the second chart looks at, this is the, again, last 15 years of the correlation between those two assets. Again, on the left, you got the S&P 500. And on the horizontal axis, you got your M2 money base. And I plotted everything. Now you can see there was a huge amount of action that happened when the money supply exploded real high. So the reason there isn't a compression in dots is because the money supply increased so quickly over the last amount of time that it couldn't even keep track. And it takes time for the S&P to catch up. But even that being said, 95.9% of the price action for the S&P 500 is explained by the increase in money supply. Okay? But it gets more interesting. Let's look at the Fed and how they're talking about unwinding the balance sheet. We heard plans of 95 billion to 120 billion kind of a month going forward. And here you can see how they've been unwinding the balance sheet. This goes back to, again, January 2020 all the way to today. You see how the money supply exploded from about 15 trillion all the way up to about 22 trillion. So they added $7 trillion. And I know people throw the term around like, oh, $1 trillion here, $1 trillion there, but $1 trillion is a lot of money. I didn't have the visual here today, but it blows the mind when you see exactly how much money it is. But if you look at how the chart has slowed down, it shot up and then it reduced ever so slightly for a few months, but then increased some months as well. So what exactly is going on? So the Fed they said they were going to unwind very aggressively. They were going to unwind to the tune of $120 billion a month for the next couple of years. Let's see how they're doing. So this is the actual chart of everything since January 2022. That's when they started saying, we're going to start reducing our balance sheet. They didn't start in earnest till April 2022, and they took about 90 billion out of it. But then in May, the money supply grew. Then in June, it shrank a little bit. It was about 30 billion. And then in July, it grew. And it grew again a tiny bit in August. And then it shrank over 100 billion in September. Shrank a little bit in October. Less in November. And then December 2022 shrank a lot. But then it grew again in January. And it shrank a little bit in February. But the point is, they had a plan of 90 to 120 billion, depending on what they were saying and how they were breaking up the mortgage-backed securities, etc. But the average that they've reduced ever since they said they would reduce the balance sheet is 28 billion versus the 120 billion. So the point is they're having a hard time reducing the balance sheet. And that goes before all the expenses that they have to start paying for, war supplies and all sorts of stuff. Then we have the recent debacle of what just happened with Silicon Valley Bank. They're going to put together a new fund, which should be some type of backstop facility. I don't exactly know where the money is going to come from that. I know there's a debt ceiling. I know they have to increase that. Deficits are exploding. States are running out of billions and billions of dollars. It's all a complete mess. And go back to this chart, everybody. Unwinding is extremely difficult and they have not been successful. So they're way, 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 way off the mark. And again, with over 212 trillion in unfunded liabilities and funded liabilities, the only ways to go forward is to increase money supply, increase printing, etc., etc. So that's kind of where we are. I just thought it was interesting perspective. Back to your case, your question is, yes, it will affect the S&P 500, but they're struggling to do it. And remember, the S&P 500 has a lot of zombie companies that will be heavily impacted by this. But if you are in fast growth names, you can make it, just like fast growth cryptos can make having high inflation too.